Good evening and welcome to iBankerU. Do you ever wonder where the price of silver is headed over the next few years? Well, you should, for so many reasons, and we'll discuss all of the big ones. Tonight, we build and walk through an institutional quality math-based model on where the next several years of silver pricing will go, as most likely to be blessed by Big Silver's gatekeepers, we know who they are, and discuss why. We wish we knew how to screen project the model. We'll learn that, but we'll leave the work in the description below for whoever wants to check our math. So without further ado, the numbers and the analysis. Tonight, we're not guessing, we're not speculating, we are building a framework, a repeatable, institutional grade methodology to forecast silver prices from today through 2032. And by the end of this, you will understand not just where silver could go, but why, step by step, with math, logic, and market structure. Let's begin. The core question: what actually drives the price of silver? Strip away the noise, the headlines, the hype, the Reddit trades, and at its core, silver is priced by three forces. Number one, monetary demand, things like inflation, real estate, currency debasement. Number two, industrial demand, stuff like solar, EVs, electronics, data centers, and those that demand it. And thirdly, supply constraints, mining output, and recycling. We are going to quantify all three. So let's build a base price model. Institutional commodities desks often reduce price to a simple equilibrium. Price equals a function of monetary demand plus industrial demand plus supply. But that's not actionable, so we refine it. We build a quant model. We construct a simplified predictive quant model where silver price equals the base inflation component plus industrial growth premium plus supply shock multiplier. You got that? Three parts to this model. We figure out each one and then we add all three together. So let's break each one down. First, the base inflation component, part one of three. Historically, silver tracks inflation, but with leverage. So, on average, if inflation rises 1%, silver rises 2 or 3%. So we model this using compounding. There's a math equation, but basically what it equals is the current silver price, and today that's about $75 as of April 9th, plus we're going to add in inflation-adjusted growth rate of somewhere between 6 and 8%. We'll split the difference and call it 7, then years. So the way the math works is P to the T equals P to the O, which is the current silver price, parentheses 1 plus R, which is the inflation rate we just talked about, raised to the power of T, which is the number of years. So in Excel, it's a lot easier. I'll link it. But basically, the step-by-step works like this. In 2027, let's assume that today we freeze the base price of silver. So basically it's just 75 times 1.07, which is we're adjusting inflation to the silver power of about 7% raised to the power of 1 because it's the first year. So in 2027, we have at a base level, remember this is component 1 of 3, of $80.25. So you do that same equation, but raised to the power of 2, so compounding the 7% annually, year over year, and that 80.25 in year 1 becomes 85.87 in year 2. Do the same thing, but raised to the power of 3, and it's about $92. In 2030, raised to the power of 4, it's about $98. In 2032, this is raised to the power of 6. It's about $112.50. So that's baseline monetary drift only. No squeeze, no acceleration, just currency mechanics. But remember, there's three components. So let's go to component number 2. We layer in reality, which brings us to industrial demand component. Again, part 2 of 3. Silver demand is accelerating, driven by solar build-out, electrification, and AI infrastructure hardware. So we model D parentheses T equals D sub 0 E raised to the power of GT. So let me translate all that. If G equals about 10% over 5 to 6 years, demand increases 65 to 80%. That translates to price premiums. So in 2027 to 2028, roughly 20%. 2029 to 2030, call it roughly 40%. And in 2031 to 2032, between 50 and 70%, we'll split the difference and call it 60. So we apply that to the new base. So the 2032 adjusted price, again, this is 6 years out, that would be that 60%, is going to be $112.50 from component 1 times 1.6, meaning we're increasing component 1 by 60%. And that gives us a price of $180, but we're only 2/3 there. So we've got to go to the supply multiplier, the real driver. So here's where things get asymmetric. So we now come to the supply multiplier component, which is the real driver, or part 3 of 3. So silver supply is inelastic, byproduct driven, and slow to respond. So we apply scenario multipliers. Balanced market, 1 times. A tight market, 1.3 to 1.5 times. And a structural deficit, 1.7 to 2.2 times. You might want to consider this a downside case, a base case, and an upside case. So for the full forecast, we combine everything. So the 2027 forecast, component number 1, monetary, $80. Component number 2, industrial, call it 20%, gets us to $96. And supply multiplier of 1.15 times gets us a final of 105 to 115. So we're going to do the same type of math for each of the following years. So 2029, monetary 92, industrial base 40%, gives us $129. And then the supply multiplier of 1.3 times gets us somewhere in the 165 to 175 range. Let's zoom all the way out to 2032, the final. And this is base case. So monetary base, 112. Industrial, 60% multiplier. So that the 112 plus 60% gets us to 180. And then the supply multiplier is 1.5, gets us somewhere between 260 and 280. So, like any good institutional model, we need cases. So where is our upside case? Fear not, that's next. In the foregoing was the base case. What happens if we stress the system? If we get sustained negative real rates, if we get capital rotation into hard assets, if we get institutional allocation to metals, well, then supply breaks and price doesn't just rise, it reprices. Apply a 2 times multiplier. So 2032, that gets us somewhere in the 350 to 400 plus neighborhood. So here's what all this means. Where are we going? And here's the key insight. $75 silver doesn't just scale the outcome. It changes the narrative. We are no longer early cycle. We are mid-cycle, approaching rapid acceleration. So remember where silver was 5 years ago? Well, for whoever, $5 per ounce, and has already increased 200% to $75 as of today, April 9th. And earlier this year, on January 29th, 2026, silver traded near $125 an ounce. So if anything, our prediction model is weighted lower than it should be, meaning there is even more upside price potential than we have laid out. So increase the previous figures by 40%, representing the lost value relative to silver's January 29th all-time high, and the price gets perhaps closer to fair. And so what would risk management have to say about this model? They would say that this model fails if inflation collapses, industrial demand slows materially, and supply unexpectedly surges. But structurally, those are low probability today. So here is the updated reality-based takeaway. The base case is $250 to $300 silver by the early 2030s. Call it 2032. The bull case, $350 to $500 plus. And the path, faster than most expect, more volatile than most can handle, but mathematically consistent. This does not even take into account the actual real fair price of silver, which, by the way, is over $3,000 per ounce. Go check out our past video on that from January 24th, 2026. The string of price targets we detailed are the expected blessed amounts by the big silver gatekeepers and all of the allegedly near flawless price suppression and rigging machinery that has been so well documented here and so many other places. But the bottom line, if you understand the inputs, you can see the future forming. And that future is a significantly higher silver price. Build that stack. iBankerU. Good day.